In 2022, global stock markets lost trillions of dollars. In 2008, even more disappeared. And during the COVID market crash of 2020, billions seemed to vanish almost overnight. Every time it happens, the headlines sound the same. The market wiped out trillions of dollars. Trillions gone. But that raises a strange question. If trillions of dollars disappeared, where did they go? Who has them now? Did somebody make off with them? Did they move into another account somewhere? Or did the money simply cease to exist? Because unlike a bank robbery, nobody can point to where it ended up. So what actually happens when the stock market crashes? And why do these crashes matter so much if the money wasn't physically there in the first place? Imagine you have £10,000 in your bank account. If somebody steals it, the money goes somewhere. If you spend it, somebody else receives it. Money usually moves from one place to another. So when people hear that the stock market lost $1 trillion, they naturally assume the same thing happened. If it disappeared from one place, it must have appeared somewhere else, right? Not exactly. Because the stock market isn't a giant vault filled with cash. It's something much stranger. It's a giant machine for estimating value. And estimates can change very quickly. Imagine a rare baseball card. Last week, somebody paid $100 for it. Now everyone says that card is worth $100. The next week, another collector pays $120. Suddenly, the card is worth $120. Nothing about the card changed. The ink didn't improve. The paper didn't become rarer. The only thing that changed was the latest price somebody was willing to pay. The stock market works in much the same way. Every second of every trading day, millions of buyers and sellers negotiate prices. Those prices become the market's best estimate of what something is worth. And because those estimates are constantly changing, so is the value of the market itself. Imagine a company with 1 billion shares. Yesterday, investors were willing to pay $100 per share. Today, they're only willing to pay $90. The company still owns the same factories, the same employees, the same products, the same buildings, the same customers. Nothing physical disappeared. Yet the company's market value just fell by $10 billion. So where did the $10 billion go? Nowhere. Because the $10 billion wasn't a pile of cash sitting in a room. It was a valuation, an estimate, a reflection of what investors collectively believed those shares were worth. And that belief changed. This is where things get confusing. When a company's share price changes, journalists often calculate the change in its market capitalization. Market capitalization is simply the share price multiplied by the number of shares. If a company worth $1 trillion falls by 10%, roughly $100 billion in market value disappears. That's where those dramatic headlines come from. But the wording can be misleading. People hear, $100 billion was wiped out. And imagine trucks carrying away cash. In reality, what disappeared was the market's estimate of value. The company didn't lose $100 billion from a bank account overnight. The estimate changed. Now, let's make things even more interesting. Imagine you own shares worth $100,000. The market crashes. Now they're worth $70,000. Have you actually lost $30,000? The answer depends. If you sell today, the loss becomes real. But if you continue holding the shares, nothing has actually been converted into a loss yet. Investors call these paper losses. The value on paper has changed. But the transaction hasn't happened. This distinction matters because during major crashes, billions or even trillions of dollars can disappear on paper long before anyone actually sells. So why do valuations suddenly fall? Because markets aren't really pricing today. They're pricing tomorrow. When investors buy shares, they're making predictions about the future. Will this company grow? Will profits increase? Will customers keep buying? Will competitors take market share? The market is constantly trying to answer those questions. And whenever the answers change, prices change too. That's why a company can announce record profits and still see its stock fall. Because investors expected even better results. The market isn't judging reality, it's judging expectations. But expectations aren't created by machines, they're created by people. And people are emotional. They become excited, they become fearful, they become overconfident, and sometimes they panic. Imagine you're sitting in a crowded theater. One person suddenly rushes toward the exit. A few others notice. They start moving too. Soon the entire crowd is heading for the doors. The fear spreads faster than the information. Markets often behave the same way. Investors watch prices, they watch each other, and when confidence starts disappearing, fear can spread remarkably quickly. At this point, you might be thinking, if the money didn't really go anywhere, why do crashes matter so much? That's where things become more serious. Because while valuations may be estimates, human behavior is real. Imagine somebody's retirement account falls by 30%. Suddenly they feel poorer. Maybe they delay a holiday. Maybe they postpone buying a car. Maybe they spend less generally. Now multiply that behavior across millions of people. Businesses notice. Sales slow down, hiring slows down, investment slows down. Economists call this the wealth effect. When people feel wealthier, they spend more. When they feel poorer, they spend less. So even though market value is partly an estimate, the consequences can become very real. Another common question is, if some people are losing money, somebody must be gaining it, right? Sometimes. Investors who sold before a crash may avoid losses. Some traders profit from falling prices. And investors with cash often use crashes as opportunities to buy assets at lower prices. That's why crashes create both winners and losers. Not because money magically moved from one giant pile to another, but because different people made different decisions at different times. Here's something even stranger. If every shareholder in a company decided to sell at exactly the same moment, many of them wouldn't get the price they expected. That sounds impossible. After all, if a stock is trading at $100, shouldn't everyone be able to sell at $100? Not necessarily, because stock prices only exist when buyers and sellers agree on a trade. The last traded price tells us what somebody was willing to pay. It doesn't guarantee that everyone can sell at that price simultaneously. If millions of investors suddenly rush for the exit, buyers may disappear. And as buyers disappear, prices can fall dramatically. In other words, some market value exists only because buyers are willing to show up. When confidence disappears, those buyers can become much harder to find. And that's one reason crashes can happen so quickly. But if trillions of dollars can disappear, another question naturally follows. How do they come back? After all, markets have crashed many times before. The dot-com crash, the financial crisis, the COVID crash. And yet, over time, markets recovered. Why? Because the same mechanism that drives prices down can also drive them back up. Remember, stock prices are based on expectations. During a crash, investors focus on risks. They imagine the worst-case scenario. But eventually, something changes. Companies adapt, consumers keep spending, businesses continue operating, and investors begin looking further into the future again. The question shifts from, how bad could things get? To, how good could things become? As confidence returns, buyers return. As buyers return, prices rise, and valuations recover. The same force that destroyed trillions in market value can eventually rebuild it. This idea becomes even clearer when we look at how billionaire wealth works. When headlines say a billionaire lost $20 billion in a single day, most people imagine a giant bank account shrinking. But that's usually not what happened. Most billionaire wealth isn't sitting in cash, it's tied up in shares of companies. If the company's share price falls, their net worth falls too. Not because money left their account, but because the market now values their ownership differently. Imagine somebody owns half of a company worth $200 billion. On paper, they're worth $100 billion. Now, imagine investors become less optimistic and the company falls by 20%. Nothing about their house changes. Nothing about their lifestyle changes. Nothing physical disappears. Yet their net worth suddenly falls by $20 billion. It's the exact same principle we've been discussing throughout this video, just on a much larger scale. This reveals something surprising about modern economies. Much of the world's wealth doesn't exist as cash. It exists as valuations, as expectations, as confidence, as beliefs about what future profits, future growth, and future opportunities might be worth. That's why markets can gain trillions of dollars without printing trillions of dollars. And it's why they can lose trillions without trucks hauling money away in the middle of the night. The prices change, the expectations change, and the valuation changes with them. The stock market teaches a strange lesson about wealth. We often think wealth is made of physical things, cash, gold, buildings, say factories. But much of modern wealth is something less tangible. Belief, confidence, expectation, trust. The stock market is really a giant machine that converts those ideas into prices. And when those beliefs change, trillions of dollars can appear or disappear without a single banknote being printed or destroyed. When the stock market crashes, it feels like money has vanished. Because that's exactly what the headlines tell us. But most of the time, the money didn't go somewhere else. What disappeared was the price people were willing to pay. The market is a giant auction powered by expectations, confidence, fear, and optimism. And when those expectations change, valuations change too. Sometimes by millions, sometimes by billions, sometimes by trillions. The factories remain, the offices remain, the products remain. But the market's opinion changes. And once you understand that, the mystery of where the money went becomes much easier to solve. And now it makes sense.